So, in the world of finance, there's this constant push to get ready for the absolute worst case scenario. And today, we're diving into the official rulebook for that exact preparation, the Reserve Bank of India's framework for stress testing. We're going to break down what it is, why it's so important, and how it actually works using the RBI's own guidelines as our guide.
It's a pretty intense question, right? But believe it or not, this is the exact question the RBI wants every single bank in India to be asking itself. And not just once in a while, but all the time, systematically. This isn't about being negative. It's all about being ready.
To really get why this is so critical, you have to go back to 2008. That global financial crisis was just a massive, brutal wake-up call. It showed that most banks' risk models had never even imagined a shock of that size. Their financial defenses just weren't built to handle that kind of storm. And that painful lesson, well, that's the foundation for the whole framework we're talking about today. Okay, so what exactly is stress testing? The easiest way to wrap your head around it is to think of it like a financial fire drill for a bank. I mean, you don't wait for a real fire to find out if your sprinkler system works or if everybody knows where the exits are, right? No, you practice, you simulate one. And that's exactly what this is. Now, if you look at the official RBI definition, it's about evaluating a bank's finances under a severe but plausible scenario. And those are the key words right there, severe but plausible. We're not talking about some sci-fi end-of-the-world event. We're talking about a realistically terrible turn in the economy, and then seeing if the bank can actually handle it. It's all about giving the leadership the info they need to make smart decisions before a real crisis hits. So this financial fire drill, it basically plays out in 4 key stages. First, you have to identify potential disasters, things like a sudden recession or a housing market collapse. Then, you simulate it. You run the models to see what that would do to the bank's entire loan book and investments. Step 3 is all about assessing the damage. How much capital would we lose? Can we still operate? And then you get to the most important step of all, using all that data to strengthen your defenses, whether that means keeping more cash on hand or just having better emergency plans. And of course, banks aren't just doing this for fun. The RBI's mandate lays out some very specific, non-negotiable requirements to make sure every bank is building this kind of financial muscle. The guidelines actually break this down into 2 main flavors. First, you've got sensitivity analysis. Think of this as tweaking just one dial. You ask, what happens if only interest rates go completely haywire? But then you've got scenario analysis, and this is the full-blown story where lots of things go wrong all at once. A recession hits at the same time as a market crash. And as 2008 taught us, that's usually how real crises work. It's never just one thing. So who's on the hook for all of this? The RBI is crystal clear here. It's not just some back-office risk department. The ultimate responsibility lies with the board of directors. They can't just get a report and nod along. They have to be actively involved, helping to decide what scenarios to test. It's their job to challenge the super complex models with simple, common-sense questions. And they're the ones who have to sign off on the final plan to make the bank safer. All right, I know this can all sound a bit abstract, so let's make it real. Let's walk through a practical example using a shock scenario pulled directly from the RBI's own rulebook. We're going to apply what the RBI calls a severe shock to credit risk. And that's basically the risk that people and companies won't be able to pay back their loans, which, as you can imagine, is a huge risk for any bank. And this really shows you just how intense these drills are. For a severe test, the RBI says a bank has to model what happens if its bad loans, they call them net NPAs, suddenly explode by 150%. And at the exact same time, they have to pretend they're setting aside enough cash, called provisions, to cover 100% of certain other risky loans. It's a massive 1-2 punch aimed right at the bank's bottom line. So here's the critical part. When a bank runs these numbers, it has to look a pretty grim reality right in the face. It has to ask, what does a 150% jump in bad loans actually do to our capital? How much of our safety buffer gets completely wiped out? Honestly, could we even survive it? And that, right there, is the entire point of this whole exercise. Stress testing forces the board, the CEO, everyone at the top to answer those terrifying questions in the calm of a simulation, not in the middle of the chaos of a real meltdown. It lets them find the weak spots and fix the roof while the sun is still shining. Okay, so let's zoom out. Why does any of this matter to people who don't work at a bank? Well, because it's not just about one bank. It's about building a resilient financial system that works for everybody. So let's just tie this all together. At its heart, stress testing is a forward-looking tool. It forces banks to get ready for what could happen, not just what's happened before. By making the board of directors directly responsible for these worst-case scenarios, it puts resilience right at the top of the priority list. And when every bank is stronger, the entire financial system becomes more stable. And that's good for all of us.
You know, this final thought really says it all. Nobody has a crystal ball. The point of the RBI's framework isn't to predict the next crisis. It's about building a financial system that can withstand it. Because when that next storm eventually does roll in, we need our banks to be strong enough to see it through. Thanks for tuning in.